In today's video I want to talk a little bit about the correlation between market manipulations and momentum divergence. Most of us already know that the simple notion of divergence does not go very far in terms of depth of analysis, and it can actually become counterproductive if you approach it in a shallow way. However, if we think about simple divergences in alignment with other layers of analysis, we can have a good result. Market manipulation is all about understanding the way in which large traders use certain psychological pitfalls that are inherent to our minds in order to induce certain traders to act in specific ways and in specific points. These psychological pitfalls are irrational, so market manipulations tend to naturally affect those who trade in the most impulsive and irrational way too. One very good example is the breakout trader. Buying at the break of a high or selling at the break of a low is an extremely visceral and pseudo-logical way of thinking about the way price action works. The natural consequence of this is that traders who operate under this sort of mentality will inevitably fall for irrational traps. Let's look at the simple example we have in the chart you see on the screen. In number 1, we have price action creating a high. Immediately after, price action goes down a little bit. In the moments between 1 and 2, breakout traders are thinking that if and when price breaks up the high of number 1, it would be a good opportunity to buy. Market makers understand this kind of mentality quite well, so they will attempt to capitalize on it as much as possible. This renders the high number 1 a good place for large traders to tilt the market. They will do this by poking the high and driving the market down immediately after, which is exactly what happened in number 2. I am oversimplifying the whole process of course because the purpose of this video is to show you that we can find an intersection between market manipulations and concepts like momentum analysis of the market. Observe that we have a simple momentum divergence happening precisely at the moment of the manipulation. Despite the fact of that being a coincidence or not, the fact is that one type of analysis helps increasing the likelihood of the other being correct, and this is one of the reasons contextual trading is such a good way to approach the market. We can subjectively confirm that what happened after candle 2 was a manipulation by looking at the shapes of the candlesticks. Markets are chaotic, so we tend to respond with skepticism when it behaves too orderly. Looking at market manipulations with some extra light like momentum analysis or any other reliable technical tool is a great way of filtering out bad readings. Another important thing that I want you to pay attention to is the down-sloping blue line. This line is important because it shows how the market will often give you a second opportunity to enter a trade once a grounded analysis is established. This blue line comes out of the high number 1 that was used as an axis to manipulate this market, and its angle is determined by how the line cuts through the upper tails around number 2, which is when the manipulation in fact occurred. Observe how the line cuts through those upper tails in a way that it seems to be tying them up somehow. Observe also how this angled line shows the next precise market reversal in number 3. All these elements working together are not a coincidence. Their recognition is the result of trying to subjectively interpret an objective data set. Contextual analysis and this more sophisticated logic are the things that enable a trader to reach a certain level of analysis that is called trading in the zone by the professionals. In other words, to get in sync with the market, we must deploy a certain amount of necessary cognitive discomfort in our analysis, otherwise we simply cannot see what is happening. It's curious to notice that technical analysis often gets a bad reputation because of the boldness of its promises. However, the boldness of the matter is actually not in the promises made by technical analysis, but it is in the minds of those who think that technical analysis is just a trick to get in and out of the market. I always like to make the comparison of interpreting charts to interpreting texts. When we try to simplify the process too much, we will inevitably lose precious information. I hope you found this video useful in some way. If you like these videos, please don't forget to click the like button, subscribe to the channel, and leave your comment below. If you don't like the videos, please tell me why in the comment section so I can improve the way in which I try to transmit the information. Thank you for watching.